Welcome to Al Stock Trades. In this video, we're going to be doing a response to Chicken Genius's recent YouTube video regarding why retail investors should stop buying the dip. If you're coming here for drama or think this is going to be an insulting video on Chicken Genius, please turn the video off. This is not it. This is going to be a pure peace and love video, an academic intellectual discussion. And I honestly hope Chicken Genius responds because we're all learners in the market. And I would love to learn more about what he's saying and what data points he's looking at. So let's start with our data analysis here. So usually the brokers that you use, they tend to sell the information to hedge funds. So this former hedge fund, get this data from, takes retail investors, essentially portfolios that have a certain amount of money versus institutional investors that have in the millions and to billions region. And it shows you essentially labels them as smart money being institutional investors and dumb money being retail investors. And there's no insult here. I'm just literally reading the chart. And as you can see right now, as the stock market has been going down, and you could quite see this, obviously, it's very obvious with the red lighting, right? Stocks have been going down. Dumb money has been selling. Dumb money has been going down, especially in the most recent, since the CPI report came and the market's been tanking. Dumb money just basically left, while smart money has been picking up, right? And this is a constant pattern. Like, for example, if you go in and take a look at the 2020 pandemic, once stocks started to sell off, dumb money essentially started selling while smart money started buying. Now, do you remember when retail investors, I believe, were at their peak stupidity? Right around January of 2021, you remember when Palantir was at 45, Tattoo Chef was high, and Coursera in the 50s, everyone's saying, stocks only go up, let's go, right? During this time, you could see that smart money was actually selling and they weren't participating in the market, while dumb money was buying. In fact, smart money was buying puts in anticipation for what we're seeing here, right? So definitely take a look at that and think for yourself. Now, let's go back in time to 2018 when former President Donald Trump, was essentially leading the country. You can see when the stock market dipped here, I believe a government shutdown happened, and I believe there's some laws being placed for Chinese stocks and the country, and then Chinese stocks have been going down. And also that dragged the S&P 500 down. You could see that dumb money started to sell while smart money started to buy. And then guess who was selling the stocks to, dumb money? It was smart money selling them back at they doubled their money. And with all the calls they did and all that, dumb money took it and they ran with it. So you can see, and I know Chicken Genius watches the All In podcast. Chamath Palihapitiya recently stated that if you do opposite of retail, you tend to make money. So this is kind of what I think he was talking about. Now, if you go into the bulls and bear ratio, again, the way you read a ratio is higher the number, or essentially bulls are taking over. The closer the number is to 1, the bears are taking over. The yellow is a bull market. And then here, this is the pink here is a recession, okay? And here is the 2020 recession. So if you take a look at it right now, we're at levels that we haven't seen since, near like 2014, 2015 levels when people were extremely fearful that we're going to head into a recession. I believe we had a taper tantrum during that time. And then 2008, great financial crisis with the collapse of Lehman Brothers and Bear Stearns, with mortgage-backed securities, and also 1994, which we had the 75 basis point hike that we recently learned about, if you're reading the articles and keeping up, and all the other crashes that we have. But as you can see, guys, the market did extremely well a year after these events, a year or two after. And it shows you that when people are at extreme pessimism, it's honestly a great time. Remember the comment, be fearful when others are greedy? Well, the time to be, not buying the dip and being fearful was up here, which is what Warren Buffett was doing. But now Warren Buffett has started purchasing stocks, right? And now you got to be greedy when others are fearful. Now, again, if I'm missing something, Chicken Genius, and I don't want to be. I'm not condescending. I'm not trying to be passive aggressive. I mean, am I not seeing something? I'm always want to learn, right? I have a lifelong learner mentality. it comes with working towards acquiring my 5th degree, which is my medical doctorate degree. So it's kind of a constant thing. You always learn, right? Always want to learn. I always say I know nothing, so I can continue to keep learning even more. But if you look at the S&P forward PE ratios for large caps, mid caps, and small caps, you can see that small caps have been pricing in a recession. They're at recession levels, as you can see, since 2008. So all the people that are holding small caps, you guys have been feeling what these large caps and what the global Wall Street has been feeling. You're like, recession? We've been in a recession, since forever, right? It's been a while. It's been a long time. You can see that mid caps are have a bit of ways to go there, and large caps they're not even close. They still have some time to fall, right? Excluding Meta, because I think Meta is extremely undervalued, right? So, and here's another way of it's essentially taking a look at it, if you like to look at this graph, but I think that graph drove the point. Now, Charles Schwab did a study where they did some dollar cost averaging, and they compared different cohorts, perfect timing, essentially trying to find the bottom, person who invested immediately after they had cash, and someone who did dollar cost averaging, who essentially systematically purchased stocks that they enjoyed, that obviously they did their due diligence on. They worked with looking at their fundamental analysis and technical analysis to develop their investment thesis. And then individuals that did bad timing, they just bought at purely top moments. And then compared to people that obviously stayed in cash, you can see that being in the market tends to do really well, right? And if you compare people that are perfectly timing versus dollar cost averaging, it's really not that much of a difference. Less than $20,000. Now, again, it's how much you value your time, right? Dollar cost averaging is brainless. While this takes a lot of time and it's a fool's errand because no one can accurately predict a market, it's literally near impossible. But amount of time you try to put into getting to that level when you realize this is impossible, imagine all the times that you miss. Again, what's what you value? You value time with your family? Do you value time with your girlfriend, your wife, your dog? I mean, think about it. 10 days you miss out, with your dog, let's say, that's 70 days, right? 7 times. I was like, think about that, because time is everything that's everything we have, right? But anywho, this is not a philosophical discussion. This is more, I guess you can mix some philosophy with academics, but let's go back and let's get to business. So we have another, so this is the bear market, and looking at all the bear markets and essentially how long do they last for. And this is from 1950 to current. So you can see the 2022 is here, right? And on average, guys, so far we've been in on this for about 5.4 months, and it's we're kind of teetering away. We're waiting to see if this is going to enter a recession level. I personally think it is, and the question is how long will it last? On average, bear markets tend to last 11 months, with a median of 7.2 months, and at long, maybe 30 months here in 2000, in the dot-com bubble crash, right? And let me just go really quickly here. By dollar cost averaging, think of a parabola where you graph y equals x squared, and you essentially get the arithmetic mean, and you essentially get to a level where you just get the average of that dip, right? Which is possible, right? Mathematically speaking. So going in about stocks, how well do they do after these bear markets? Well, they do extremely well. If you look at the 12 months afterwards, we're looking at median average returns of 23%. And here are all the ones that are broke down completely. I know 2020 was crazy because the monetary easing and that we had with the pandemic. So there's that. Let's go forward. So again, how soon, after a bear market do stocks bottom? Well, obviously it depends. But on average, it's 154 days to 81 days being the median. And obviously, there was one time point, the great dot-com bubble crash, where the stock market really had a terrible time. Took a couple years to even get out of that, even to get into a position where the market was doing well. But the markets have become very efficient. A lot of people are thinking, or might get numbers anywhere between the 87s, 47, 46 days. But on average, this is the statistics from the 1950s to current. Now, Obviously, bear markets have existed without recessions, and I personally think we are going to head to a recession based on the 10-year -2. But if you look at the 10-year minus the federal funds rate, it's saying something else. I don't have the graphs there, but please consider subscribing, liking, commenting, and sharing, and I'll upload that video PowerPoint set for you guys, and we'll talk about what that means if you don't know. But as you can see here, on average, again, 5 to 7 months. And here are the fastest recessions, and these are recessions defined by NBER. On average, 10 months with a median around 10 months. And if you want to be even more bearish, 18 months. Elon Musk says around 15, 18 months because he's deriving it from this number here and taking it from these types of numbers here, the top and the two highest peaks, right? But as you can see, guys, it's not that long if you look at how long do bull markets last, right? And these are stocks, the stock returns during recession levels. And this is going all the way back from 45 to March of 2020. Again, 2022 is not a recession yet. And you can see the average is around 10, 11 months. So again, guys, I don't see Chicken Genius's, thinking here of essentially stop buying the dip. When in reality, it seems that these are the best opportunities to buy a dip. Now, I'm only speaking in companies that you can find their intrinsic value, when we can look at their revenues, their net income, their gross margins, their free cash flow, and arithmetically go 10 years into the future, discount back at a 10-15% discount rate using a 2-3% perpetuity model, dividing by the number of outstanding shares, which leads you the stock price. That, well, you can go in and find those stocks that are undervalued and know when to get in and get out based off of the fundamentals tracked again with market sentiment, which what we just basically did right now, sentimental analysis. So I don't see it. Hopefully, I know he quit YouTube, but hopefully he comes back and we can have a good, academic, intellectual discussion, because, that's amazing, right? So I think, be able to have, build a community where we can just come together and talk without being hostile, right? But I hope this was a good video. Please comment, like, share. Please tell me what you think. I want to know. This is a one-on-one discussion, and it's this is a great time to learn. All right, guys. God bless you, and I will see you on the next one.